Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend some time with us. It's always fantastic to have a show on the same day that the Federal Reserve is about to announce an interest rate policy change. And yes, many of us are expecting a change, as much as maybe a quarter point cut coming out or announced at around 2 p.m. this afternoon. It's always exciting when we have our show as the same day as a central bank policy meeting or an announcement. We've had our show with the Bank of Canada announcing their policy changes before, and now the Federal Reserve today. Much anticipated, a day that many have been looking forward to. Many people perhaps a little nervous to see what happens at 2 p.m. But overall, it's going to be an exciting day and makes for an exciting show that we have for you today. Let's put up some of our topics. Along with the Fed announcement that we are expecting at 2 p.m., which we will talk about a little later in the show, we're going to have for you an interview that I did a few days back. It was with a panel of 3 tax experts, tax specialists, and we're going to talk, or we spoke about, I should say, this interview was done a few days ago. We spoke about the term tax fairness panel, we called it. What tax fairness means to these tax specialists and these tax experts, what the government should be looking at going forward, and discussing things such as increasing taxes on a certain segment of the population, the higher income earners. Is that something that the government should be doing and should be considering? We hear the talk about this all the time as of late, especially in the US with an election coming up. So I spoke to our tax specialists, and we're going to bring you that interview right off the top of our show. So I hope you all enjoy it. Obviously, tax is a very small word, but has a very large effect on all of our lives. After that interview, we're going to talk about the Bank of Canada and speculate about their next steps. We just got a reading recently, received a reading of a CPI, a measure of inflation. 2% was the reading in Canada, which, as many of you will recognize, is the bank's target rate. So now what happens? What are they going to do? Are they going to decrease rates quicker? Are they going to decrease rates at the same pace? What are they going to do? So we're going to speculate a little bit as to what the Bank of Canada should be doing and what they will do. As always, top 3 things to consider over the next 10 business days. These are ideas that I think all of you need to be focused on before you make your investment decisions. And finally, your questions. As I always like to take 1 or 2 questions from our audience. If you have any questions during our panel discussion, our interview, please put them in the chat boxes, and I'd love to answer them at the end of the show. Or if they're a question for some of our guests, by all means, put those in the chat boxes, and I'd be happy to convey those questions to our guests and have them answer those questions as well. So without further ado, let's move forward with our fantastic interview with 3 tax experts. I'd like to welcome to the show Fred O'Riordan of Ernst & Young, Jake Fuss of the Fraser Institute, and Tim Sesnick of our family office and a regular columnist with the Globe and Mail. Fred O'Riordan is the national leader tax policy at EY Canada. He plays a significant thought leadership role with E&Y on global tax policy and tax controversy. And he also works with companies to work effectively with the Canadian Revenue Agency. He joined E&Y in 2010 after a 33-year career in public service, which includes 20 years experience in senior roles with the CRA. Welcome to the show, Fred.
Thanks, Al.
Jake Fuss is the Director of Fiscal Studies for the Fraser Institute. His research covers a wide range of policy issues, including government spending, debt, taxation, labor policy, and charitable giving. He's also written commentaries appearing in major Canadian newspapers, including the Globe and Mail, Toronto Star, and National Post. Welcome to the show, Jake. Thanks for coming out.
Thanks for having me on.
All right. And Tim Sesnick is the co-founder and CEO of our Family Office, Inc., as well as the author of Regular Tax and Personal Finance column in the Globe and Mail. His firm, Our Family Office, provides strategic offerings and wealth advisory services to ultra-high net worth individuals and families. He's also an author with multiple best-selling books. Welcome to the show, Tim.
Thanks, Alan. Glad to be here.
Excellent, excellent. Thank you so much, gentlemen, for agreeing to come on our show. And you know, I guess everybody, or the number one thing I hear from most investors that I deal with is tax, right? Everybody's looking to save tax, whether it's on an annual basis, whether it's trying to provide or I guess have their estate transferred to the next generation, to their beneficiaries in the most tax efficient way. Tax is on the minds of all Canadians, and you know, there's obviously a reason for that. You know, the levels of taxation, especially in Ontario, are one of the highest in North America, and we know this. And I guess recently we heard the concept of tax fairness. We heard this idea and a lot of talk about this earlier in the year in Canada when the federal government uh, raised the tax levels for capital gains, the inclusion rate for capital gains tax. And most recently, we've actually been hearing it down south, our neighbors to the south, with Vice President Kamala Harris talking about if she was elected as president, what she would do to raise tax, corporate tax, individual taxes. And again, this whole idea about the wealthy, certain segment of the population, the higher income earners, just not paying their fair share. So I thought that's where we would start. So I guess my first question to the three of you is, what does tax fairness mean to you? And do you think the wealthy don't pay their fair share of tax? And I guess we'll start it off with Fred. What do you think about tax fairness?
Well, for readers who read the Globe and Mail, I guess you probably already know my opinions because they're on the record. I wrote an opinion piece earlier this summer about this, whether the wealthy pay their fair share. Tax fairness means different things to different people. I mean, that's the first thing to start with. So you're never going to get a consensus across the board on what is fair. But if you look at our progressive tax rates in Canada, and particularly those that impact the wealthiest individuals, in 8 of 10 provinces, they're all over 50%. And my piece, Keith, it was really triggered by a commentary around the 24 federal budget, where there was this suggestion that middle income people are paying higher marginal tax rates than the wealthy. And that's only true if you compare apples and oranges. In other words, capital gains with regular employment income and so on. Taxes are confidential, so we can't look at individual tax returns in the general public, but Statistics Canada does publish aggregate tax data. So that's the source that I used for that opinion piece. And just to quote one statistic out of several that were there, the top 1% of Canadians at the highest marginal tax rate pay about 22% of all personal income taxes, and they only earn 10.4% of all income. So that gives you an idea of how steep the progressive tax rates are in Canada. I would say, in addition to that, sure, there are wealthy people who don't pay their fair share of taxes. There always will be. There are middle income people who don't pay their fair share of taxes. Tax compliance is a problem across the board. I would think that it's probably similarly problematic at all income levels and thresholds and so on. So you're always going to have some element of wealthy people who don't pay their fair share. But overall, yes, I would, in my opinion, the wealthy are certainly paying their fair share.
Paying their fair share. You know what? The way I look at tax fairness, Jake, is for me, when they're talking about making taxes fair for everybody, you usually hear, okay, someone is not paying enough tax, so they should pay more. And yet someone perhaps is paying too much and therefore should pay less, kind of even the playing field. But as we know, they're not going to cut taxes for individuals. They're only going to raise tax on the higher income earners. So what does tax fairness mean to you?
Yeah, I mean, similar to Fred, I mean, I think there's many different definitions of tax fairness, but the one I usually use is the relationship between income and taxes. So we can kind of think of as your income rises, generally, so too should your taxes. Now, whether that's in proportion to your income or a more progressive system where the tax rate increases even higher as your income rises, I think that's where a lot of the debate goes to. But for me, I think when we're talking about this issue, I think similar to what Fred was talking about, we need to be grounded in the facts about how much different income groups in Canada are actually paying in taxes already. So what we calculate, for instance, is that the top 20% of income earning families in Canada are paying about 54% of all taxes in Canada currently. They're paying about 2/3 of all personal income taxes, largely due to the progressive nature of the tax system currently. And I think that's really the frustrating part for me in the conversation. When we have these debates about fair share of taxes, it's not usually rooted in actual definitions of what actually constitutes a fair share. They just say, high income earners have to pay more. And really, it's not grounded in any baseline or any facts or truth on the matter of how much they're currently paying. So in my opinion, generally, when we're looking at the distribution, the top 20% of income earners in fact in Canada are actually the only ones that are paying a higher share of the total tax bill in Canada relative to their share of income earned, because they're earning about 46% of all income in Canada, but they're paying about 54% of all taxes in Canada. That generally seems, fairly fair from that standpoint. So I think that's really the frustrating part for me in a lot of this conversation and debate.
Yeah, and Tim, what I did recently, interesting enough, is I had some work done on my house, and I went to some of the individuals that were working on my house, and I asked them, and I don't know where they sit, which bracket they sit, tax bracket they sit in terms of income, but I said to them, I said, when you think about taxes and this idea of tax fairness, are you bothered or upset by the fact that perhaps someone who earns more is perhaps not paying as much tax because they're, having their income flow through a corporation or perhaps doing some other thing? And it's funny, the reaction I got from this individual was, no, I'm not upset. If I could do it, I would do it too. So this whole idea of our government trying to talk about tax fairness and trying to raise taxes and saying it's because we need to level the field for everybody that is paying tax. What do you think about that? Why does our government continue to go to the higher income earners and say they need to pay their fair share when, as we've just heard from both Fred and Jake, that they are paying their fair share?
Well, yeah, it's a good question. I think the answer is a political one, right? The government, it seems more politically correct to target higher income earners and suggest that they're not paying their fair share, and therefore appeal to the masses or the average Canadian who probably assumes that if you're making a lot of money, you're not paying their fair share. But as both Jake and Fred have suggested or have shown, the stats show otherwise. In fact, I think my big concern here is when the government says they're not, wealthy people aren't, or just higher income earners just aren't paying their fair share. As Jake said earlier, what does that mean exactly? Can you define what their fair share should look like? Like, let's talk about what is enough. How much is enough tax to pay? And then, have a debate about that. And then, if Canadians aren't paying enough, wealthier Canadians aren't paying enough, then by all means, let's work towards what they should be paying. But I think what you're going to find is when you see the proportion of personal income tax and just total taxes that higher income people are paying today, people would say that's enough. And another stat, which I know we're talking about statistics here, the bottom 20% of income earners in Canada pay just 0.8%, less than 1% of taxes. So there is a progressivity to our tax system. That's the way it's been designed. And by the way, as somebody who works day to day with some of the most affluent families in the country, they would all say, without question, that they're okay to pay more tax than someone who makes a lot less than them. They're not debating that. Nobody is saying that a progressive tax system is a bad idea. Many people would say, look, if I make that much more, then I should pay a higher percentage of my income in tax. But there comes a limit where enough is enough. So, currently the highest marginal tax rate in Ontario, for example, is 53.53. It's a pretty high rate. And just to put that in perspective, and I know we'll probably talk about other jurisdictions, but put that in perspective, if you took all of the Canadian provinces and all the US states, and if you looked at the number of those jurisdictions, and that there are 61 of those jurisdictions, and you took the top 10 most highly taxed jurisdictions out of those 61 in North America, 9 Canadian provinces occupy the top 10 most highly taxed jurisdictions, and all 13 Canadian provinces, all Canadian provinces fall in the top 13 of those jurisdictions. So compared to the US, we are very highly taxed. And so we can debate about what's the right number, but really let's define what fairness means in actual dollar and actual percentages. Let's talk about what fairness means, because I think we're there.
Yeah, and I think we're going to touch on percent that you should be paying of tax based on your income a little later, because I have some ideas on that. But it kind of takes me to I guess my next question. I guess we'll ask Fred. What the high income earners, obviously they're hearing about this term tax fairness. I know that Tim was saying that people that he talks to, clients, investors he talks to, they don't mind. But what do you think, Fred? Like, what do you think people are thinking, especially some of these high income earners? I've had lots of conversations of people that are quite upset about this, and what are the ramifications of continuously going to the well, as I call it, and asking these people to pay more?
Yeah, well, first, the first part of your question, how are they feeling? We get a lot of feedback from high income earners as well as you guys, and I think the overwhelming feeling is feeling underappreciated and targeted. I think it's not because they don't feel they should be paying the amount of income tax that they're paying, because after all, they're successful. So everybody feels as if they should contribute back to people who are more deserving in terms of the income scale. There are other ways for governments to redistribute income. They shouldn't be relying solely on the Income Tax Act, as an example, on personal income tax. As for the second part, concerns, I guess most of them, and a lot of us as practitioners are concerned that going back to the well could mean increasing the tax burden at that level even more. And one example, of course, was the increase in the capital gains inclusion rate this budget. The worst thing would be to increase marginal tax rates at the top, or create a new threshold income level and a new rate and so on, as was done in 2016. The reason I say that is, although it may have a political appeal, just think about it. What you're doing is, if your claim is that the wealthy aren't paying their fair share, all you're doing is incentivizing them to pay less, and more of them to pay less, because the return on tax avoidance or tax evasion increases as the rate goes up. The return on that behavior is higher. So the last thing you want to do is ratchet it up more. Arguably, you might get more tax revenue by reducing the rate. And I'm not going to go out on a limb and actually make that or stake that claim, but there is a certain logic behind that point of view.
Yeah, for sure. And Jake, I've been talking to some individuals, small business owners. I've actually had some friends, acquaintances, 3 of them in the last 12 months actually pick up and leave Canada, move down to Florida. We've been hearing that a lot about that lately, going down to Florida. A lot of people from New York moving down to Florida as well. People are moving to where they're going to pay less tax. I know, former CEO of Amazon, Jeff Bezos, moved from Seattle area, Seattle, Washington, down to Florida. And then he went off and sold off a whole bunch of shares of Amazon, saved hundreds of millions of dollars in tax. So, to me, that is a big ramification of continuously going to the well and trying to raise tax on these individuals. What do you think there, Jake? Have you come across, or have you heard of people, going to that drastic measure to actually pick up and leaving the country? I have heard a few.
Yeah, absolutely. I mean, the empirical research is very clear on this. High skilled workers are highly sensitive to tax rates in particular. So they're going to locate themselves in the jurisdictions where they can, minimize their tax bill, or, pay less than they would in another jurisdiction. I mean, just even anecdotally, we can even look at, with sports superstars, for instance. A lot of them have the advantage of going to Florida or to Texas, where they pay no state income tax. It's a lot more attractive to those superstar athletes to be there than it is for them to be in Toronto or other Canadian jurisdictions, where they're paying considerably higher, millions of dollars more in taxes than they would in those states. Never mind the other advantages from weather or other things as well too, that might attract them to those jurisdictions. But I think that's really the big problem here right now is that, Canada is a global competitor for people that are highly skilled workers. And the more that we make it more difficult for them to locate themselves in Canada, that just makes it harder for us to attract and retain those immigrants that come to Canada, but also retain the people that are already in Canada. So they go down to Silicon Valley, Texas, Florida, other areas where they think they can earn more, have a higher standard of living. And at the same time, too, by raising tax rates on marginal income for top income earners, we offer this disincentive for them to invest and to be in Canada as well. So we don't get as much entrepreneurship. We don't get as much working, saving, investing, all the things that we need more of in Canada to be more productive and ultimately to get those economic growth gains that actually allow people's incomes to rise over time. All we're doing right now is really disincentivizing a lot of that productive economic activity.
Actually, along the same lines, Jake, we work with a lot of affluent families, and higher income earners have the means and the ability to move wherever they want to, really, and many, in fact, already have homes in other parts of North America or other parts of the world. And so it's not difficult for them to get up and just move someplace else. In some cases, the only thing that keeps them in Canada really is a connection to family. And I don't want to downplay the importance of that connection and the importance of that. But if that's the only thing that's holding people back from moving, we have a problem. There are people who create businesses and decide to create businesses in Buffalo rather than in Southern Ontario, because either corporate taxes are lower or personal taxes are lower. That's problematic for our economy. For
Absolutely.
creating jobs and in GDP per capita, it's just not good.
Yeah, and actually, again, Tim, you're good at leading me into my next question. So start with your productivity. Bank of Canada, right? We've heard from the Bank of Canada recently talk about our productivity and the fact that it's, GDP over 2% last reading is kind of being masked by all the immigration coming into the country. And there's a lot of talk about productivity on a per capita basis, and we're actually one of the lowest, if not the lowest, in the G7 right now. And again, talk out there from CEO of Royal Bank talking about this very thing about taxes, that we need to look at the Income Tax Act again, because the way I look at it, it's definitely hurting our productivity. It's definitely hurting businesses, to be more productive, to be more efficient, for workers to actually want to work more hours. I talk to people all the time, and the factories, and they say, why would I work time and a half? That extra money I'm being paid just goes to the government. So they don't even want to be there extra time, which obviously hurts a business. So what do you think about taxes and productivity? Obviously, they're related, are they not?
Yeah, for sure. And besides that, I mean, I think if we're going to improve productivity in Canada, we need investment. We need investors to invest money in businesses here. And who wants to bring your money to Canada to invest here with rates of tax that are as high as they are? It's not easy to attract investors. Or attract investment, and that's a big problem. So, you can believe what you want about how much tax higher income people are paying, but there needs to be a better thought out plan than kind of shooting from the hip when it comes to just trying to increase the wealthy at higher rates. And I think what we've seen over the last 2, 3, 4 years, maybe decade even, Allan, is this government in particular bringing out changes in tax legislation that they haven't thought through very carefully. We've seen that they've constantly they introduced changes to the capital gains rates, and then of course that became effective June 25th of this year, and then they discovered there were problems with the legislation after that. And in fact, they announced the changes and the deadline before they even came out with the legislation. So it's like ready, aim, fire. They're not thinking through some of these changes very carefully, including the implications on investment in Canada and what that means for our economy and our GDP per capita and all kinds of other metrics.
And great points. And Fred, in terms of obviously higher taxes here, as all of you mentioned, compared to a lot of the other jurisdictions in North America. So Fred, do you think this is hurting us in terms of competing against the United States for foreign money for business? Do you think this obviously lack of productivity per capita basis Is this holding us back against other countries that we're competing against?
So there's a fair bit to unpack here when we talk about productivity and particularly labor productivity. So I would sort of pull it back a little bit and sort of start by recognizing that our sagging labor productivity, which is a huge problem, I think it's the most important economic issue and challenge in the country. It's a function of not enough capital per worker. You know, in order to raise labor productivity, we've got to look at more investment and investment in non-residential structures, infrastructure, IP, and so on. We spend a disproportionately high amount of our capital on residential, on housing, and you know that's pretty well established. So, in order to encourage more investment, tax is one factor, but it's not the only factor. So I know we're focusing on tax, but we shouldn't forget that there are lots of other things in terms of public policy. There needs to be a better alignment of a variety of public policies and regulatory policies and so on to attract that capital to Canada. If we look specifically at taxation, we've talked more about personal taxes than corporate taxes. Personal taxes are definitely a problem, as Tim has gone into some detail to explaining. I don't need to do that. On the corporate side, we're actually relatively still competitive. I'm not suggesting that there's not room to improve on the corporate side, but if we look in particular at the marginal effective tax rate on capital, so you won't find that in the Income Tax Act for readers. I mean, this is a construct that we economists use, basically looking at how much tax there is on the last dollar of investment and so on. We call it the marginal effective tax rate or the meter. We're in most sectors, we're relatively still competitive with the United States, our main concern and our main competition. Our competitiveness has been reduced. U.S. tax reform cut away a lot of the tax advantage that we have. So we do see a big impact there. And our meter is probably going to deteriorate further because there's a lot of accelerated cost measures, capital cost allowance measures and so on that are set to sunset. So we'll have to see what the federal government does. We'll have to see what the U.S. does on their side too, because they've got a lot of incentives that are temporary in nature. So I do agree. I think all of us are probably going to be in violent agreement about the importance of tax, but we shouldn't ignore a lot of the other things like interprovincial trade barriers, difficulty starting projects, environmental assessment legislation that is cumbersome and slow, and so on.
Yeah, I know you bring up great points. A lot of other things to consider. Hey, Jake, one of the things I talk about a lot is with the kids. You know, our kids growing up, kids that are going to universities, that are coming out of university looking for jobs, and to them looking at where they're going to set up shop. Right, they come out of university looking for a job, looking to start working a business. I just worry at times what this says to our younger generation. I know, talking to a few individuals, and it's actually heads of companies that have their kids in schools outside of Canada, and they're not coming back. They're staying in jurisdictions that they think are better for themselves going forward. So, what does this say to our kids? What does this say to the younger generation? If you do well and you're successful, well, the government's going to take 53 cents on the dollar and you get to keep 47. Again, all flows into this idea of efficiency, productivity, just being a better country, a better place to set up work and job. What are your thoughts on that?
Yeah, I think it's a huge problem right now in Canada. I know there's a lot of frustration, especially among young people, because they can't afford homes. They can't get the jobs or incomes that they want, especially in proportion to the size of the mortgage that they have to take on. So I think this is a huge problem, and I think Fred would absolutely hit the nail on the head there too. It's not just a tax issue; it's also a government regulatory and policy environment too that's not conducive to growth and not conducive to people getting these jobs that they want. And then there's so many barriers in the housing sector, for instance, that the governments have imposed that have made it difficult, whether it was on zoning laws, developer fees, or other things that have just really added to the bill of the cost of building housing as well, which is just adding to the frustration of younger people in particular, because they can't afford those homes. And a lot of new immigrants who come to this country can't afford the homes too. So it just really sets up this vicious circle, where we're getting into deeper and deeper problems. And the answer from a lot of governments has been to double down on the same policy approach, maintain the status quo, rather than actually making broad and bold policy reforms that we need. Things like interprovincial trade barriers getting removed, regulatory environments that is not conducive to business investment, that's not conducive to building projects that we desperately need in Canada. And then also on the tax file, I mean, making changes like increasing the inclusion rate on capital gains. Well, the only thing that's likely going to do is scare away more investment into Canada, or cause people to just lock into the current investments and not move that capital to more productive uses as well over the long term. So I think there's a lot of frustrations with the current policy direction in Canada, and we need to start rethinking these things so that young people are allowed to stay in the country, and actually have that job growth, income creation, and more affordable housing for them over the long term too. We just can't keep going in the same direction that we're going now.
Yeah, no, again, great points. I guess for our last conversation piece or topic, wanted to throw something at you guys, and something that I talk about with certain individuals, and it resonates whether or not it's possible. I understand the government has to generate revenue. Obviously, the government needs to pay for things. And talking to the premier, had him on our show not too long ago. He said that the they don't have a revenue problem, they have a spending problem, and he was very adamant on that. And he actually said he wouldn't be raising taxes anytime soon in Ontario, so that was a good thing. But I guess, what would the three of you, think about a flat tax? Now, I understand there may be a lot of pros and cons to a flat tax, but wanted to get or end off our conversation today with all three of your opinions on a flat tax. Let's say we set a rate of 25%. So the person making 100K, they would pay $25,000 in tax. Someone making obviously 50,000 would pay $12,500 in tax. If you were to everyone pays the 25%, like you said, you would broaden the base, you would bring down taxes for some, increase taxes for other. Could that work? Could that, in theory, work? I guess we'll start with Tim. What do you think about a flat tax as opposed to having all these different tax brackets? A lot easier, a lot simpler.
Well, I think you hit the nail on the head when you say simpler. I think that's the argument for people who are looking or suggesting that a flat tax makes sense. It is simpler for sure, but I've never really bought into the idea that it's actually very practical or necessary. For one thing, like I mentioned earlier, most of Canada's higher income earners don't actually mind a progressive tax system. It's just how progressive is it, right? How high do those rates get? So I don't think a progressive tax system is necessarily a bad thing, and a flat tax is simpler. But what I think we do need to simplify the tax system is tax reform. We have not had a royal commission on taxation since the 1960s, when the Carter Commission was established, and they came up with some pretty sweeping changes to our tax legislation at that time. And that's really what we need again. And that will help to, with the view of simplifying, make the system fair if you think there are things about it that aren't fair, but to simplify it as well. I just don't really think a flat tax is going to be the right answer. I think you'll always come across scenarios where somebody needs a tax preference because of this or that or another thing, and you're going to get back to where we are again. So I'm not sure that's going to be the solution.
Okay. And Fred, why should paint this scenario for you? Someone goes to school, gets their degree, gets a master's, comes out making a good salary, good living, versus someone that perhaps, stumbled their way through school, got a diploma of some sort, and, really didn't put their efforts, maybe their education is not on par with the other individual, comes out as making less money. Why should the person who's coming out making well over six figures, why should they pay 53% tax? They worked their whole life, they since they were young, and they come out and say, you know what, I deserve it. I deserve to keep more of the money that I make because I earned it. What do you say to those individuals? Why wouldn't a flat tax then be the right idea?
Well, to those individuals, you'd be speaking to the converted, of course, because they would favor the flat tax because they would benefit more from it than people at lower income levels and so on. I mean, we've all sort of circled around the same thing. The tax fairness is difficult to pin down. It means different things to different people. So 53% is a pretty high tax rate. Anything over 50%, just psychologically, that's a high tax rate. I agree with Tim in the sense that I think most people don't oppose the idea of a progressive tax system. They recognize that they've got to contribute and they've got to help pull other people up by their bootstraps and so on. I mean, that's part of what it is to be a good citizen or a good Canadian and so on. I think to focus on flat tax, though, is sort of the extreme opposite of the extremely progressive system we have now. There are some other advantages of a flat tax. I mean, Tim mentions simplicity, and that's clearly the obvious one, but neutrality would be greatly improved. I mean, neutrality is a huge problem in the current tax system. All of these taxes have some wonky, aspect to them. Like the corporate income tax, people like it because they think they don't pay it. But we know a lot about tax incidents, and the corporate tax is either passed on to consumers in the form of higher prices, or it's pushed back on workers and suppressing wages and so on. So incidence matters, neutrality matters. There's a lot of investments that don't go to the best use because of the tax incentives that are baked into the system. Some of them intentional politically, and some of them unintentional. Even the income tax in general is a terrible tax base. We'd be better off putting more focus and emphasis on consumption. We earn about in this fiscal year, I think about 56% of all taxes are personal income taxes. About a quarter, maybe 24%, 26% on corporate taxes, and the HST is down around 13% or so. I mean, it would be politically difficult, and most politicians prefer to lower that rate than increase it. But that's the kind of thing. I mean, so there's a lot of scope for improving the tax system. I would love to see a comprehensive tax reform. I wouldn't oppose a flat tax, but in all of those thoughts, I just don't think there's a political will to do it across the political spectrum. I mean, tax is kind of kryptonite for a lot of politicians when you look at significant important tax reforms.
And I think talking to again hearing some of the people on the conservative side on the federal level, I think they're planning on taking a look at the Income Tax Act. Perhaps if Mr. Poilievre comes into power, maybe that's something he will do. I think I thought I've heard somewhere that he looking into perhaps taking a look at that, and when if he becomes elected and is the next prime minister, what they will do. I guess a lot of people are waiting to see if he'll return the capital gains inclusion rate back down to 50%, or will he leave it at the new proposed rate? I think that's the first thing he's going to look at. But I guess to end with yourself, Jake, what do you think? Do you think, obviously, it sounds like Tim and Fred are kind of, flat taxes on one side, progressive is on the other. Maybe something in the middle makes sense. What do you think? Do you think a flat tax can work, or do you think it's got to be, something in the middle between the two?
Yeah, I think it's a good conversation to have. I mean, I agree with Tim and Fred in the sense that I think we definitely need a tax reform in this country, looking at the tax mix in terms of, GST versus, income taxes and corporate taxes and how that looks. That's definitely way overdue. We haven't had a proper commission on that in a long time. So we definitely need to have that discussion. On the flat tax issue, I'm generally in favor. I mean, if we look at Alberta recently had a system where they had a 10% flat tax, and they also had a 10% corporate income tax. So they were actually treating it equal across, to Fred's point about neutrality, and, a dollar is a dollar essentially. Another country as well to look at is Estonia. So they currently have a flat tax across the board for their sales tax, for their income tax, and for their corporate tax at about 20%. And I believe it's actually going up to about 22% soon. But they're a very successful country, even though they're not a very well-known country in terms of their economic progress over the last 30 years or so. They have one of the highest business startup rates in the world, one of the highest in Europe. They also have a very robust economy in terms of productivity growth, very good education system and other things as well. So I'm actually generally in favor of a flat tax system, mainly due to making it a more simpler system, so that you're not punishing people as their income rises and they're being more productive in the economy as well. Because right now there is a bit of that penalty with the progressive system, whereas you earn more money and more of it gets taken away by the government, for instance. So I do think that's something that we can look at. And part of that discussion too would be getting rid of a lot of the tax credits and exemptions in the system to make it a lot more simple, so that you're treating every dollar the same. And I think that's the really important point when we're talking about flat tax systems.
Yeah, I guess for me, I'm with you, Jake. I guess a lot of my clients would love to see a flat tax. I know Tim and Fred bring up points why perhaps may not be the right way to go, but you mentioned a few jurisdictions where it actually is working. So good to hear. Maybe our government needs to take a page out of some of these other areas. But yeah, hopefully we've today uncovered, or at least gave individuals something to think about with regards to taxation, and hopefully, the powers that be, the federal government, provincial government, can take some ideas or take something away from some of what you said today, and perhaps we can and will see change because, as you all mentioned, I think we are. I think last time I heard we were the fourth highest jurisdiction for taxes in North America, and I'm not sure if that's changed recently, but that's pretty high. And I know people living in Ontario, I know the provincial government will say it's the federal government, and everyone unfortunately lays blame somewhere else. But overall, it's we're paying a lot of tax, and I'm sure those in BC would say the same, in Quebec, et cetera. So I want to thank all three of you for joining me this afternoon. It's been a pleasure. Nice to meet all of you and to speak with all of you. I hope all of you come back on our show at some point in the future. Again, I want to thank Fred O'Riordan, Jake Fuss, and Tim Sesnick. You've been fantastic and giving us all food for thought, and talking about what I think is the point of contention for all Canadians. I think all Canadians feel as though our taxes are not up to date. Like Tim said, we haven't looked at the Tax Act and taxation, how it's done in quite some time. And I think, hopefully our government will take a look at that going forward. So once again, thank you, gentlemen. It's been a pleasure. And thank you again for sharing your insights with all of us. Thank you.
Thank you.
Thanks, Allan.
Thank you.
Before we get to our next topic, I want to thank three individuals, Jake and Fred and Tim, for coming on and discussing tax. As I said, it's a three-letter word, a small word, but yet carries such a lot of weight with individuals. All we hear about is trying to save taxes, and how tax is a conversation with everybody, trying to save taxes on the money that they make, the money that they pass along to their beneficiaries. There's a lot of tax planning, estate planning that is done on a regular basis. So the word tax, unfortunately or fortunately, means different things to different people. And I think for the most part, most people in this country believe that we pay perhaps too much tax. And hopefully our government will take a look at the taxes we pay at all levels of government. And perhaps we can see a change in tax policy. So now I wanted to get on to our next segment, which is about the Bank of Canada and speculating what the Bank of Canada is going to do going forward. And as I said off the top of the show, we received some inflation data recently. The CPI data came out, and our first chart that we have will clearly show this. And it talks about how CPI has come down. We've actually seen CPI come down to 2%. And if some of you are sitting there saying, hey, I recognize that 2% number. Yes, it is the target rate for the Bank of Canada. It's also the target rate for the Federal Reserve in the US. They want to see an inflation rate of 2%. And so here we go. We have it. And the interesting thing is, when you compare that to what the Bank of Canada rate is currently, the bank rate is, you're looking at a rate of about 4.25%. It was 5% earlier this year. It's come down 3 times, and now at 4.25%. So as you can see by this chart, things are moving in the right direction, but you can still see that the difference between 2% and 4.25% is more than double. So that tells us that, yes, the Bank of Canada has a lot of room to continue to cut rates. The question becomes, how quickly and how much are they going to cut per meeting? And recently, CIBC Bank has come out and said that they believe the Bank of Canada will cut more aggressively, perhaps as much as 50 basis points cut at the year-end meeting. Their last meeting for the year might be 50 basis points, followed by maybe 50 basis points early in 2025. So taking a more aggressive stance on interest rates. And I'm not so sure about that. And I'm not so sure that people won't call into question the credibility of the Bank of Canada. They raised rates 10 times very quickly without hesitation. We talk about this lag effect when you raise interest rates, what it means for the economy. And we all know that it just doesn't change things right away. It takes some time before the economy feels the effects of an interest rate increase. And so here we are with the Bank of Canada now cutting rates 3 times in a row, and perhaps they'll cut maybe 4 or 5 times in a row before the end of the year, and maybe even a 50 basis point cut. Does that mean that the Bank of Canada went too high, too far, too fast, only to now cut back? I think that's a question that some people are going to ask. And I guess, there's definitely a consideration for cutting more or cutting quicker. And the next chart that we have, which is Canada GDP, has stalled. It shows GDP stalling. You can see the orange line here. So Canadian growth definitely flatlining, not really going anywhere. At the same time, if you look at the blue line, which is the unemployment rate in our country, now above 6.5%, highest level we've seen in quite some time. At the low end, unemployment was somewhere around 5.5%. Now it's well over 6.5%. So you look at unemployment rising, you look at GDP stagnant, and you look at inflation finally reaching our target of 2%. Well, what's keeping the Bank of Canada from cutting rates aggressively and quicker? Well, the answer may be in our third chart here, which is housing. And what we see here is any point in time where the Bank of Canada cuts rates, obviously those areas of the economy, interest sensitive areas of the economy, like real estate, like housing, they tend to benefit when rates are cut. And obviously, it is a negative for those or that sector of the economy when rates go higher. So we've seen spikes in housing, home sales. We saw a spike in 2009. We saw a spike just after COVID. Again, rates that were cut, housing really took off. And now we've seen housing coming down over the last couple of years, and that's because interest rates went higher. Well, what happens if we start cutting rates even more aggressively than we already have? Well, does that mean that housing goes out of control again? And that's something I don't think the Bank of Canada wants to see. I don't think that's something government wants to see. And I know even all of us would not like to see housing prices, just start to go like gangbusters once again. It'll be very difficult, even though maybe a mortgage rate might be lower for individuals. But if the price of a home is skyrocketed once again, that's going to be a difficult thing. And so I think even though we've seen the Bank of Canada or we've seen the inflation rate reach our target of 2% here in our country, it doesn't mean that the Balancing Act and the questions and I guess the Bank of Canada kind of walking on some eggshells here, that doesn't end. They have to figure out now how to deal with perhaps an increase in unemployment. Remember, the central bank mandate is for full employment and price stability. Well, we now have price stability. So now I think the Bank of Canada is going to tackle this unemployment or full employment issue. So going forward, I believe the Bank of Canada will continue to cut rates. I don't think there's much doubt about that. But I'm not so sure that they're going to cut as aggressively as some are calling for or perhaps predicting. But again, time will tell. And as always, if they continue to cut, it will be a stimulative for certain parts of our economy, perhaps our banks, our housing sector, perhaps some utilities, dividend-paying stocks, I think will get a bit of a boost. So definitely, we will see some stimulation for our markets, for the interest-sensitive parts of our economy, if the Bank of Canada continues to cut and if they were to cut more aggressively. Now the part of the show where I like to highlight 3 things that I think individual investors should be focused on before you make your investment decisions. And as we've said off the top of the show, Fed rate decision day, the day has finally arrived where we get to hear what the Federal Reserve wants to do with respect to interest rates. Will they cut 1/4 point? Will they cut 1/2 point? How long can the markets keep hitting new highs? Well, we all know that when markets hit new highs, usually they can maintain those highs only for a certain amount of time. And at some point, the market will sell off. So how long can they keep these highs going? And lastly, or our third idea, what could upset the markets? Again, another thing that individual investors need to keep in mind. What could pop up or what could happen or what's going to happen that could derail the markets and cause the markets to pull back. So let's start with the Fed rate decision. And I think a good chart to start with is actually the U.S. Consumer Price Index chart, where we show the difference once again between where inflation is versus the Fed funds rate. And you can see inflation, like it was in Canada not too long ago, sitting at around 2.5%. And you look at the Fed funds rate, you're looking at a Fed funds rate above 5%. You're looking at here the, I guess, the less food and energy, or the core inflation rate at 3.2%. And so, again, coming down, but still not at where the Fed would like it to be. If you look at the next chart that we have, which shows PCE, once again, you're showing a 2.5% inflation rate. There it is. And pretty much most of the measures that the Fed uses to look at PCE, whether it's core, whether it's headline, you're coming in roughly at 2.5%. If we then move forward to a chart that's going to show, here it is, the difference between the Fed funds rate. So Fed funds rate and the 12-month changes, chart number 10 there, we can pull that up. You'll see that it goes 5.25%, 5.5% versus 2.5%. There it is right there. And that shows the big gap, the gap between what the Fed can do and where things are sitting now. And again, like in Canada, well over double the inflation rate is where the Fed funds rate is sitting right now. If we show the US Fed target rate, chart number 9 there, we can see that, you can see that the Fed fund, or the rates have gone up extremely high over the last few years. It's now pretty much flatlined for a little while now. And I think many people are saying it's now time. It's now time to make a move. It's time for the Fed to make a move. And the question is whether they go 25 basis points or 50 basis points. And there is a lot of confusion behind that. So on one hand, you have an inflation rate coming down to 2.5%. You have let's take a look at unemployment. Let's take a look at jobs growth, jobs creation, monthly job creation in the US. You can see numbers coming down there. There you have it. We've seen a number of revisions in the jobs report. And not surprising, last month we were over 100,000 jobs created, and ended up being only 89,000 jobs created. Jobs for the month of, sorry, that was for the month of July. For the month of August, last month, we have a number of about 142,000 jobs created. And if the trend continues, we'll probably see a revision down to that as well. So jobs are coming down along with the inflation rate. Job openings are coming down. We are definitely seeing a slowdown in the economy and in the market. So that would call for the Fed to perhaps take more of an aggressive tone, maybe cut 50 basis points. But then you look at other data, like, for example, retail sales. U.S. retail sales have been pretty strong. There's the monthly change in U.S. retail sales. Last month, it was actually revised, but revised upward. It actually was more or greater than a 1% retail sales number, which you don't see often. You can see that it hasn't been over 1% in quite some time. This past month, so in August, July was revised above 1%. In August, you're looking at slightly above what they were expecting as well for retail sales. You also look at GDP. If we can pull up our GDP charts here, there you go. You can see that at our last revised look at second quarter GDP, it was 3%. 3% growth rate for the United States is great. And from what I've been hearing, the third quarter is kind of trending around 3% as well. So if you look at retail sales and growth numbers like GDP, you would say, why would the Fed need to cut rates aggressively? But then you look at the unemployment rate going up, you look at jobs creation and jobs growth kind of getting slower, and you might say, well, maybe 50 basis points make sense. So overall, to me, whether it's a quarter point or 50 basis points, I don't think it matters. What I do think matters most is that we are going now in an interest rate cutting direction, and that's important for the market and certain investments within our portfolios. Second point I wanted to make with regards to before you make your investment decisions, you should think about, can the markets continue to move higher? Can we continue to reach all-time highs? And our first chart here we have of the S&P 500 showing at an all-time high, which I think most of you know, the markets are at pretty much all-time highs. So what can keep markets making all-time highs? Well, the first point I wanted to make is consider what is happening now. the Federal Reserve, Bank of Canada are starting to cut interest rates. Now, normally we cut interest rates or we see interest rate cuts, and the market's usually having difficulties. It's struggling. Economy is struggling. The market is struggling. The Bank of Canada, the Federal Reserve, needs to cut rates to become more stimulative so that economy can get better. And obviously, if the economy gets better, stock market will follow. Well, right now, we're actually going to see cuts by the Fed today, by Bank of Canada already, while the market is at all-time highs. So one would think, well, if we're cutting with the market at all-time highs, yes, it is possible that we can make new highs if we get more stimulative interest rate policy by the central banks. What's to prevent the market from going higher? You start cutting rates, good for the economy, good for interest-sensitive areas like technology and many other parts of the economy. We know tech makes up 50% of the S&P. And yes, I think you could see this market continue to go higher based on this idea that central banks are now cutting rates, even though we are at all-time highs. A second reason why I think this market can make new highs is this idea about PE ratios. And we have a chart here, S&P 500 PE ratios. And a lot of people will say, well, the PE ratio for the S&P is pretty high. And it is. But if you strip out the Magnificent Seven, if you can go back to the chart we just had, if you strip out the Magnificent Seven, right there, yes, thank you, you would see that it's actually not that expensive at all. You're probably trading around 18 times earnings. So yes, the Magnificent Seven, seven largest companies, biggest tech names, biggest companies in the world, they have that much of an influence on the overall stock market. So they make us feel that the market is expensive and therefore should be sold, when in fact, 493 stocks are trading at reasonable valuations, 18 times, 17 times. So the market is not expensive if you factor out some of these big cap tech names. So these are two reasons why I believe, yes, the stock market can continue to make new highs, even though, you know, we may think, well, how high can it go? What goes up must come down. I hear that all the time. No, in this case, I think we will see the market higher by the end of this year than it is today. Our third point, or that I wanted to convey today for individual investors to consider when you make your investment decision, is what could hurt the markets at this point. And, you know, in life, it's funny. It depends on how you look at things, right? I tell you that the market is actually not that expensive if you factor out the Mag 7. Well, our first chart, we actually showed it briefly a moment ago, our chart on the S&P 500. Now, this would be the total S&P 500. And you could see that if you factor in all stocks, yes, the S&P 500 is expensive when you look at it from an historical standpoint. So yes, valuations getting stretched, that could bring down the overall markets. And it's something that I think individual investors need to focus on. Valuations, markets getting too stretched. A second point that could bring down the markets possibly is the upcoming election. And we hear a lot about the upcoming election, what it can do, what is being promised by the candidates, cutting taxes, raising taxes, etc. And it's something that I know investors are paying attention to. Our next chart here, S&P 500 rally, is backed by rising earnings. There you have it. We've seen earnings rise. We've seen the stock market rise right along step or right with it. But you can see there, corporate tax policy reform could shift U.S. earnings per share trend. So raising taxes, if the United States were to start raising taxes, corporate tax, individual taxes, it could change the dynamic. It could cause the stock market to start to pull back. It could start to get nervous. And depending on what taxes you raise, corporate, individual, start putting taxes on unrealized gains for individuals. These are all things that I believe could hurt the market and cause the market to sputter, to perhaps pull back a little bit if whoever's in the White House were to raise taxes. And for that matter, I know former President Trump talks about putting on or increasing tariffs. Many people believe that a tariff is just like another tax. So we'll have to see who, I guess, wins the race for the White House, who is in the White House come November. I guess they don't take office until the new year, but who's elected in November and what their tax policies are, tariff policies are. And that could go a long way as to what happens with the stock market. We have another chart here. S&P 500 has posted gains during the calendar year where, we see a cut in taxes. And that's not always the case. Sometimes we see a cut in taxes and the market moves higher. Sometimes we see an increase in taxes, which is the dark line or the dark bars, and we still see the stock market move up. So we can see taxes rise and the stock market rise. And sometimes we see taxes being cut and then the stock market rises. So it's mixed. There's a mixed feeling. And I think that's why there's so much uncertainty with respect to tax policy and with respect to, what's going on, what's going to happen come November. And again, to me, that is something we need to watch for. And lastly, with regards to what could derail or bring down markets, if the Fed decides not to go along with the game plan of the stock market, right? Stock market thinks that the Fed is going to cut rates 25, 50 basis points, maybe cut as much as 100 basis points or 1 full percentage point by the end of the year. But what if the Fed doesn't go along with that? What if they only cut 50 or 75 basis points? Will the market react positively? Probably not. I think the market is getting ahead of the Fed. I think investors are trying to guess what's going to happen, and they're trying to make their investments prior to that. So if the Federal Reserve doesn't go along with what the stock market anticipates, this too could cause the markets to fall. So if you're an individual investor today, I think what you want to look at, as I said, you want to look at the Fed rate decision at 2 p.m. today and what they say going forward. I think you want to look at, indications or ideas on if this market can continue to maintain its current path. Can it continue to make new highs? And lastly, what can derail these markets? And I think if you look at those three things, more macro in nature today, the points I'm making today, I think that would be important before you make your investment decisions. So I know the show's gone on a little longer than we liked. I know I tend to say that often, but I always want to take at least one question from the audience, and I know we have a few here. One, I guess, a shorter question here. If inflation is coming down, how does that affect the stock market? And I wanted to take that one. There were a bunch of questions there, but I thought that went really well with today's show. And how does that affect the stock market? Well, it doesn't affect the stock market directly, but indirectly, when inflation is coming down, you hope that the Bank of Canada and the Federal Reserve will also bring down interest rates to match inflation reaching their targets. And when we bring down interest rates, as I said earlier, that hopefully will stimulate a lot of the interest rate sensitive areas of the economy, and therefore the stock market gets a boost for that as well. So indirectly, as inflation comes down, hopefully interest rates come down, and that hopefully gives a boost to the stock market. So with that, I want to say thank you to all of you for watching our show today. I hope all of you took away something from our tax talk. I hope we were able to convey some great ideas, flat tax, talk all about everything you wanted to know about tax. We also spoke about what Bank of Canada should be doing. And of course, the Federal Reserve at 2 p.m. today, we'll all be watching to see what they do, whether it's a 1/4 point cut or a 50 basis point cut. So once again, I want to thank everyone for joining us today. And I want to say I look forward to seeing all of you again in a couple of weeks. I guess that is now October. Wow. October the 2nd at 12 noon. And until then, happy investing.